Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave yes in the comment, and we are here to help you obtain insight and build wealth. The book we are going to share today is The Little Book of Market Wizards by Jack D. Schwager. Demystify the market magic. Some people seem to possess an incredible instinct for anticipating market movements. These market wizards operate on another level, applying analytical frameworks honed by experience to profit from any market fluctuation. How do these extraordinary individuals manage to beat the market averages and consistently come out on top? And more importantly, how can you do it, too? In this sharing, we're going to explore 7 trading secrets gleaned from interviews with the trading wizards of the financial market. These lessons are derived from stories told by top global hedge fund managers, proprietary traders, and commodity trading advisors who have generated enormous returns while skillfully managing risk over decade-long careers. We're going to hear stories from the likes of Paul Tudor Jones, Bruce Kovner, Michael Marcus, and Stephen Cohen, and distill their collective experience into real action you can take to improve your trading experience. It's time to demystify the magic behind their incredible success. With discipline, trading can be emotionally effortless. Before we continue, if you are interested in this topic, please consider subscribing and give us a thumb up. Let's continue. Match the method to the man. Michael Marcus achieved phenomenal success trading for the legendary Commodities Corporation, turning a $30,000 stake in $80 million in under a decade. This was despite the firm withdrawing over 30% of profits annually. But before this success, it took time for Marcus to get his footing. Early in his career, Michael lost his entire original $500 trading stake in 2 weeks. After his father passed away, he tried to invest the $3,000 of insurance payout he received. Within months, poor decisions again wiped out his entire stake. While these initial failures were tough, Michael walked away with something just as valuable, an understanding of himself. He had an epiphany that his strengths were in short-term trading, based on identifying aligned fundamental, market tone, and chart patterns. Instead of trying to follow other people's advice and market rumors, he developed a unique trading style that suited him. If you want to succeed at trading, the most important step is finding a methodology that fits your personality and belief. There is no single correct way to trade the markets. The right approach for you is the one aligned with your individual talents, trading style, and risk tolerance. Don't worry, your learning curve can be far shorter and less expensive if you start out by reflecting on your own beliefs, talents, and risk preferences. Learn about different methods of trading, and get to know what works for you. Jim Rogers is a renowned investor and trader, co-founding the profoundly successful Quantum Fund with George Soros in the 1970s. Jim is known for his long-term, fundamental-based approach to trading. He focuses on identifying major macro trends, often years in advance, and emphasizes patience in waiting for ideal conditions before entering trades. Let's contrast that with Marty Schwartz, whose technical analysis-based system suited his abilities as a short-term trader. Marty spent a decade losing money in his early career when he tried the same large-scale predictions that lead to Jim's success. However, once he switched to a technical style of trading, using indicators like chart patterns and breakdowns, he began to achieve remarkable results. For all of these men, their success came when they put faith in their own skills and unique style. By trading in harmony with your personality, you'll have a much greater chance of success, whatever style you land on. Persist through failure. Failure is not predictive. Even the greatest traders often fail early in their careers. Persisting despite initial setbacks is instrumental in discovering one's potential as a trader. No one is born a perfect trader, and abandoning it too early will prevent you from traversing the necessary learning curve needed to succeed. We've already heard about Michael Marcus's repeated failures when he was starting out. It takes time to understand the markets and yourself. Marcus went on to compile one of the greatest trading records of all time, but he would only do that by incorporating the lessons he learned through his losses. You, like Michael, will need to persist through failure. Paul Tudor Jones, one of the top global macro traders ever, had a similar and auspicious start. In his first trade as a fledgling broker in 1976, He ended up buying too many contracts, given his startup capital. Paul was inexperienced, fresh from graduating from the University of Virginia, and with limited knowledge of market trends. Prices quickly moved against him, wiping out nearly his entire account. The final straw came when he was caught napping at his desk after a long night partying in New Orleans. Paul was fired from his job as a commodities broker at the New York Cotton Exchange. Shaken and jobless, he briefly considered a career change. Jones was determined to learn from early mistakes. He focused obsessively on money management and emotional discipline. Within 5 years, Jones had crafted a legendary career, achieving a record string of 5 consecutive triple-digit return years. His quantum leap in skill started with deep introspection after initial failures. 18 years later, Paul would become the chairman of that same cotton exchange from which he'd been sacked. These men didn't become trading legends overnight. Failure from the off is the norm, even for those who ultimately end up reshaping markets. Treat your early struggles as lessons, preparing you for the valleys inevitable later on. Persistence and retaining confidence are instrumental to weathering that learning curve. If you focus on building your skills, you're setting yourself up to find great success. If Michael or Paul had given up, their huge potential would have gone unrealized. Don't let that happen to you. Manage risk first. Don't focus on making money, focus on protecting what you have. This was the advice that Paul Tudor Jones gave when asked for the most important lesson he could offer aspiring traders. Money management is far more important than trade selection, according to our market wizards, in determining success. With effective risk control, even the most mediocre strategy can produce consistently positive results. Failure might be normal and important for your learning curve, but impulsive decisions don't need to ruin you either. Bruce Kovner, founder of the hugely successful Caxton Associates hedge fund, learned this lesson the hard way. After an impulsive trade cut his account nearly in half in one day, he became absorbed in developing effective risk management strategies. Kovner's key principle? Define the adverse price point where you exit a trade before entering it at all. By setting a maximum tolerable loss in advance, he removed the temptation to rationalize staying with a losing position. The sunk cost fallacy refers to the tendency of traders to hold on to losing positions too long because of an unwillingness to realize losses. You get emotionally attached to what you've already put into a trade, and it can be hard to let go, even when the initial rationale for the investment is proven wrong. By setting a maximum tolerable loss in advance, Kovner enforced trigger points that would cause him to pull the plug on a trade regardless of how much capital he'd already invested. Deciding it in advance allowed him to be objective and unemotional, saving himself from the sunk cost fallacy altogether. Stephen Cohen is the founder of the multi-billion-dollar hedge fund SAC Capital. He stresses the necessity of cutting losses, saying traders are wrong frequently, no matter how skilled. It's all about how you manage it when that happens. Steve's advice is that if you aren't sure whether to liquidate, sell half. By incrementally reducing exposure, traders can still benefit from the upside, while limiting the downside if they're wrong. Risk control reflects humility, which is essential to success. Losses are inevitable and unavoidable when trading. Accept these losses with grace, and move ahead into your next opportunity. Cultivate patience. The Bible of trading philosophy, Reminiscences of a Stock Operator, declares, "It was never my thinking that made big money for me. It was always my sitting." Co-author Edwin Lefebvre explains that most traders lose by trading constantly, instead of patiently waiting for ideal opportunities. This ability to wait is the defining characteristic of all our market wizards. The urge to take action leads amateurs to trade marginal setups, forfeiting gains. This timeless advice rings true today. William Eckhart, trading luminary, researcher, and teacher, emphasized that exiting prematurely from a winning trade is actually the biggest reason traders fail. The desire to lock in gains limits reward. Letting profits run requires conviction and patience. Patience is an important trait many people don't have, observes Tom Baldwin, a bond trading legend. While amateurs trade frequently, the pros are patiently stalking the trades with the best risk-to-reward potential. Bruce Kovner, whom we discussed in our last section, agreed. He avoided even watching intraday price changes, refusing to have a quote machine at his desk. He wanted trade signals from his system based on end-of-day data, avoiding temptation to overtrade. Having continuous prices is like having a slot machine at your desk, he explains. This is even more important nowadays, when smartphones and internet connections means traders have easy access to real-time numbers on the go. Avoid the data flow trap and the bad trade habits that come along with it. When David Ryan mentors people who want to emulate his proprietary trading career success, he shares the analogy of a hunter stalking prey. A cheetah with near-perfect ambush skills will still wait for days for the ideal conditions. Trading patience means enduring boredom between trades and releasing your ego's desire to win every trade. Cultivating patience allows traders to pounce only when the odds strongly favor success. Harnessing this skill multiplies earnings exponentially over time. So, next time you are eager to force a trade, imagine the cheetah camouflaged in the bush, gaze focused on distant prey. Wait until conditions are right before you pounce. Remain flexible. Adaptability is vital for trading success. Markets evolve dynamically, and mechanical rules effective at one time often degrade. Successful traders exhibit flexibility in adjusting their strategies and views to changing conditions. As Cole Moshe emphasized, traders who are successful over the long run adapt. Paul Tudor Jones demonstrated adaptive thinking in reacting to the October 1987 market crash. On Thursday, October 15, he was adamantly bearish, heavily short going into the weekend. However, assessing the radically altered landscape Monday morning, he quickly realized he'd been wrong. Jones nimbly adjusted, rapidly covering his entire short position and leaning into the new regime. His flexibility allowed him to sidestep steep losses and capitalize on the new trends. Stan Druckenmiller, who achieved 30% average annual returns trading for George Soros, described Soros rapidly reversing their selling mindset after the Plaza Accord, based on the radically different policy implications. By fluidly adapting rather than clinging rigidly to their prior assumptions, they profited enormously. Markets evolve, and locking into a static trading style guarantees obsolescence. Methods must be continually updated and portfolio allocation adjusted to changing correlations. Beyond adjusting strategy, flexibility involves updating market views. Cole Moshe is a successful hedge fund manager who has traded for firms like Citigroup and George Soros's Quantum Fund. In 2009, he was bearish on global markets following the financial crisis. However, observing China's economic turnaround and upside moves in metals and the Australian dollar, O'Shea quickly realized his pessimistic thesis was wrong. Rather than rigidly sticking to his original view, O'Shea flexibly adapted to the shifting conditions. He pivoted his perspective to an Asian-led recovery scenario that better fit the emerging evidence. By rapidly adjusting his market outlook to align with reality, O'Shea avoided missing the ensuing equity rally. His ability to drop his bearish bias in the face of contradictory price data exemplifies the type of adaptive thinking and mental flexibility characteristic of successful traders. Control emotions. Fear, ego, impulse, and adrenaline are invisible enemies sabotaging countless traders. Internal biases cause irrational decisions, provoking avoidable losses. Emotional control is vital for trading success, but antipathy to risk makes it challenging. Michael Marcus poignantly described the dangers of an ego attached to trades. He recounted agonizing over abandoning his large, winning soybean position during an epic commodity bull market. Despite extreme pain watching what could have been massive additional gains vanish, he finally exited, violating his plan. Subsequently, prices collapsed rapidly. His emotional need to be right almost caused disaster. Ego makes it excruciatingly difficult to acknowledge mistakes. Marty Schwartz advised that one view trading as a probabilities game. Even with a sound approach, some trades will lose. Accepting defeats as inevitable allows traders to escape the devastating effects of hoping to be totally right. Barry Greenstein, acclaimed poker ace, emphasized ego as the key driver of bad decisions for traders and poker players alike. Fear and impulse sabotage success equally. Impulsiveness caused a youthful Bruce Kovner to lose half his account in one instant. He later described that moment as temporary insanity. Avoiding that same insanity became the foundation for his tolerable loss strategy, which we talked about earlier. The anguish over this impetuous trade instilled an enduring respect for disciplined risk control. Steve Cohen highlighted fear's impact, saying large positions often cause anxiety. Worrying about an open trade impairs judgment regarding whether to take profits or cut losses. This is the logic behind his own risk control method of selling half when traders are second-guessing their positions due to fear. It relieves pressure, but still retains exposure. Controlling emotions requires stoic detachment from outcomes. Contrary to Hollywood portrayals, great traders await certainty before acting. They avoid ego attachment to trades and remain unmoved by fear. That's the end of today's sharing. If you like our content, please give us a thumb up and share it with your friends. See you next time.